Look at this stack of cash in a bank vault. While it sits there safely, it's actually losing value every single day. Thanks to inflation, the purchasing power of this money mathematically shrinks over time. To outpace that invisible decay, your money needs to go to work. The most reliable way to beat inflation is to put that capital into growing, profitable businesses. That brings us to the share market. At its core, this is simply a centralized hub where buyers and sellers meet to trade fractions of ownership, or shares, in publicly listed companies. But if you're new to this, you hit a wall almost immediately. Everyone says buy stocks, but the second you try, you face confusing choices about exactly where and how to get them. Choosing between these entry paths helps determine the specific types of risk you'll encounter and the amount of time you'll need to spend managing your investments. In India, these transactions are organized around two major physical arenas. This is the Bombay Stock Exchange, the historic institution where the country's trading culture was born. And this is the National Stock Exchange, representing the massive, modern scale of today's trading. Both exchanges offer the same two pathways to ownership. The first path is the primary market. This is where you try to buy brand new shares directly from the issuing company before anyone else gets them. The second path is the secondary market. Here, the company is completely out of the picture. You are trading pre-existing shares exclusively with other investors. But before you even pick a path, there's a major logistical hurdle. How does an absolute beginner execute a trade safely without handing money over to an unverified broker or falling for a scam? Before risking a single rupee, you have to weigh the structural trade-offs of both markets, and then properly set up the accounts required to access them. Let's look at this comparison matrix to break down your options. We'll start with the primary market, where the main vehicle is applying for an initial public offering, or IPO. The advantage here is fixed pricing. As you can see by the lock icon, you secure a base price for the shares before they are exposed to the wild fluctuations of the open market. To play in this space, you have to block the application funds directly in your bank account using ASBA or UPI. The money stays frozen for a set number of days. But look at the guarantee row. Allotment in an IPO is never guaranteed. It's driven entirely by demand. If a company is highly sought after, the IPO gets oversubscribed. When that happens, the distribution turns into a lottery, and you might easily end up receiving 0 shares. The hidden cost of missing out is that your capital was locked up and unable to earn any yield for the entire duration of the application. So, the primary market protects you from immediate price swings, but brings high uncertainty about whether you'll actually acquire the asset in the first place. Now we shift our focus on the matrix to the secondary market. Here, you buy shares through a broker's platform at whatever the current market price happens to be. The first major benefit is certainty. As the green checkmark shows, the moment you hit buy at the market price, you instantly acquire those shares. The second major benefit is extreme liquidity. You can buy a share on Monday and sell it on Tuesday. You have constant access to your capital. The cost for that instant access is complete exposure to real-time volatility. Prices here are driven entirely by supply, demand, and the daily news cycle. This chart of a wildly fluctuating market shows the inherent risk. You could easily buy shares at a premium at 10 a.m., right before an unpredictable market dip wipes out that value by lunch. The secondary market solves the problem of access, but it forces you to absorb the psychological stress of watching your portfolio's value bounce up and down. Whether you choose to wait for IPOs or actively trade, both paths require you to cross the exact same logistical gateway. Here is the workflow you have to complete. It starts with Know Your Customer, or KYC requirements. You must submit your PAN, Aadhaar, and link an active bank account to verify your identity. This diagram breaks down the dual account system you'll need. The DMAT account acts as a digital vault to securely hold your shares. The trading account is the engine that actually executes your buy and sell orders. Keeping these accounts open involves financial friction. You'll face account opening fees, annual maintenance charges, and per-trade brokerage commissions. Fixed broker fees eat directly into your margins, especially if you are starting with a small amount of capital. Factoring in these costs is a mandatory step before you execute your first trade. To choose your path, you have to match the market type to your personal risk tolerance and the time you have available. This decision tree will help map out your profile. The first profile is the wealth builder. You don't have the time to sit and monitor screens all day, but you want to buy into fundamentally strong companies early in their life cycle. If this is you, the decision tree points you toward the primary market. You apply for IPOs and accept the uncertainty of the allotment lottery in exchange for avoiding daily price stress. The second profile is the active aspirant. You want to build and manage a diversified portfolio on your own schedule, and you require instant liquidity. The tree routes the active aspirant to the secondary market. You get immediate execution, but you must have the stomach for daily price volatility. Whichever profile fits you, remember that legendary investors built wealth through intense patience and strict adherence to their strategy. They do not chase daily hype. A strict warning for beginners: avoid unverified third-party advisors, private chat rooms, or anyone promising you guaranteed returns. As the diagram shows, all legitimate market execution, whether you choose the primary or secondary path, must flow exclusively through a verified SEBI-registered broker. When you're ready, fund your new accounts with a small test amount. Use money you can afford to leave untouched. This lets you learn the mechanics of the market without putting your financial life at risk. Inflation erodes the value of cash over time. By selecting the market that fits your goals, you can navigate these risks and use your capital to pursue long-term growth.